Okay, so we're going to spend the next few slides discussing additional expenditures during an asset's life. All right, so for example, if you've got a vehicle, um, it's going to need maintenance, repairs, and we're going to talk about how to account for those. All right, um, and so the general idea is we have two broad categories. All right, um, revenue expenditures, which are treated like current period expenses. So these are things that maintain an asset, that keep an asset in its normal working order, like oil changes, new tires, and stuff like that. Changing filters and things. If we're talking about a vehicle, right? Tune-ups. Capital expenditures are things that make an asset's useful life extended, or I should say extend an asset's useful life, or add functionality. So again, keeping with the vehicle as an example, uh, engine overhauls are capital expenditures. Um, New transmissions, right? Or if you've got a truck, putting a lift on the back of it is a capital expenditure. It adds new functionality, right? So the general idea is that capital expenditures are, um, well, they go to the asset account. So they're capitalized in an asset account and then expensed in the future, i.e. they're depreciated, all right? Um, Another example that you come across is um, planes, jet planes, all right? Um, well, jet planes have a relatively long life. I mean, some planes have been in the air for over 30 years. Um, but the engines attached to the wings are have a finite life, right? They're retired after so many flight hours, right? So if you're on a 30-year-old plane, there's a good chance that the engines attached to the bottom of the wing are not 30 years old, right? Because new ones have been attached. So that's another example of a capital expenditure, right? Those would be depreciated, all right? So this kind of sums up what I was just saying. Ordinary repairs and maintenance revenue, they go directly to the expense account and the income statement in that period, all right? Betterments and extraordinary repairs are capitalized and depreciated, right? Things that extend their life or add new functionality, all right? Okay, and of course, we'll spend some time journalizing revenue and capital expenditures, all right? The last thing we'll talk about in this chapter is when an asset is no longer of use to the company, then what happens at that point? Well, the company will dispose of it, and at that point, there will be two accounts on the books of that company, right? There's going to be an asset account if we're dealing with a machine, or if it's a car, a vehicle account, and then there's an accumulated depreciation account related to that asset. All right. So when you dispose of an asset, you have to remove the asset's cost. Now that's going to have a debit balance, so you'll credit that account because we're zeroing it out, and remove the accumulated depreciation, which would have a credit balance, so we debit to zero that out. If you are able to sell it for cash, obviously you're going to debit cash, for any amount received for the old asset, and then you're going to have a plug. So if you need a credit to make the journal entry balance, you have a gain on disposal, or if you need a loss, or if you need a debit to make the journal entry balance, you'll have a loss on disposal. All right. And this is the abstract. Of course, we'll work through this a few times in class. All right, this is just a continuation from the previous slide, comparing cash to the book value. So if you receive more cash, or if the cash received is higher in value than the book value, the asset is disposed of at a gain. All right. If cash received is less than the book value, assets disposed of as a loss. If cash is equal to the book value, no gain or loss. All right.